by Dave Raub, president of Outlook Capital Management. Dave, we spoke just over a year ago about many of the economic red flags in the news, housing bubbles, inflation, et cetera. So I'm curious to see what your thoughts are now that a year has gone by. We know that consumers are feeling less confident about the economy, particularly regarding inflation. Do you think prices will continue to rise before they start to fall? And if so, for how long?
The frightening headlines recently have been inflation rates in the 8 to 10% range. I don't think those are going to last much longer. We see anything from maybe 1 to 6 more months of such inflation numbers. And if we had to bet, we'd bet it's going to be on the shorter end of that range.
What is the impact of increased energy fuel on the overall inflation calculation?
Inflation is energy and fuel costs are supposedly 7.3% of the CPI. That's a statistic. And like every other statistic under the sun, it needs to be taken with a big grain of salt. The BLS, Bureau of Labor Statistics, which is in charge of calculating the inflation rate, tries to place energy costs in 2 of the 8 main categories of the CPI, and those are transportation and housing. And it tries to measure those direct costs just in those 2 categories. But a few seconds of thought tells us that easily that energy costs show up absolutely everywhere. They show up in an infinite number of manufactured goods, from plastics to everything else. They show up in the costs of production and the costs of even service jobs, in everything from transportation to lots of other ways. So the 7.3% number, it's an interesting number, but what is it to try to actually do a calculation based on it? It only goes too far. What it suggests, because we've seen this tremendous increase in oil costs and gasoline costs and so forth, and their headline numbers, and they're frightening everybody. And when you hear, okay, it's only 7.3% of the CPI, it does tend to suggest, okay, maybe it's not as bad as all that. And that's legitimate. Another way of looking at that is, what is the share of consumers' disposable income or spending, retail spending, that is spent directly on gasoline and so forth? And I actually don't remember that number, but it's a low number. It's actually, even when you have double or triple gasoline costs, it's kind of hard to make the case that all by itself, fuel costs are suddenly going to bring the consumer sector of the economy to a screeching halt. They don't.
Are we in a recession right now?
So here's another, on the one hand, on the other hand, the answer is no. We're not. That's the common sense answer. The most commonly cited definition of a recession is 2 straight quarters of where gross domestic product, GDI, most gross domestic income, is negative. And last quarter, I think we had 1, and I don't even remember what the number was, but it was some small amount negative. So that's all the media needs, of course, to come out with big black headlines saying we're halfway to a recession, watch out below. Actually, that 2 straight quarters of declining GDI, gross domestic income, is not the real definition of inflation. The Bureau of Labor Statistics is the outfit which is in charge of informing the country when we started and finished a recession. And their rule, it's kind of a long sentence, but it says something like, we'll define a recession as a significant decline in economic activity spread across the economy, lasting more than a few months, and which can be seen in declines in real gross domestic product, declines in retail spending and real income, declines in employment, industrial production, and retail sales. So it's understandably and appropriately, the Bureau of Labor Statistics says there's no such thing as one little measure, which ought to define that we're in a recession. It has to be a much bigger picture. And the nice thing about that big picture, if you just think about the things the National Bureau defines, most of those things in that long sentence are rather remarkably strong, right up to today. Jobs are strong, strong, strong. Employment is very strong. There's been no sign of a decline at all in that. Industrial production is well, it's not off the charts, but it's been very solid, quarter after quarter, month after month. Retail sales have been strong. And it would be very, very difficult. Of all the things that NBER names there, of course, the most sensitive ones is employment and jobs. So when you start seeing the employment numbers fall in any serious way, the Bureau is more likely to say, oh, now we really have entered a recession. But what those numbers actually tell me, tell our firm right now is nope, we're not particularly close. It's going to take a lot more damage and pain than the impressions, the big headlines are kind of trying to get across to us. It's going to take a lot more than that to actually push the U.S. economy into a real recession. And I just don't see it happening for a while.
The housing market seems to be softening as mortgage rates rise and affordability decreases. How long do you think this will last, and how do you see it impacting the home improvement industry?
When you're asking yourself, will recent changes slow the market or kill it? And it's something like the housing market. The very first and primary question to ask is, how strong is the household sector? Households are that market. How financially strong are they? When anybody, business, household, anybody, suddenly rounds the corner and a bear jumps on them, there's some big problem. Nothing matters more than how financially strong they were before they rounded the corner. And the answer to that is absolutely unmistakable. U.S. household financial strength and business financial strength are off the charts historically. They've been off the charts for 2 years. They began growing off the charts 14 years ago after the 2008 and 2009 financial calamity and global bank run, which scared the living daylights out of people. And, it should have, but people reacted normally to that. When people get scared, they say, I don't want to be this scared again. What do I do about it? Well, I strengthen myself. Same thing with businesses. And so businesses and consumers spent 10 to 11 years strengthening themselves to a remarkable degree. Then along came the virus and lockdown calamity, frightened the daylights out of everybody again. What do people do when they're frightened? They strengthen themselves. And so that shows up in all kinds of statistics like debt to equity for households, and even more importantly, the ratio of household debt service, all the costs the monthly checks they have to write to pay their credit cards and their mortgages and so on, compared to household disposable income. Those numbers are at 40-year highs. Well, it would be 40-year low for debt service to disposable income. They're spectacularly good. Same thing for the business sector, its liquidity and its cash flows. They're just somewhat off the charts by historical comparisons. So when you sort of say, okay, now we have this great big problem, this threatened recession come along and rising interest rates and so forth, and how bad is it going to be? And, is it going to be a killer? The very first question to ask is, well, how strong are we going into it? And we know the answer to that. We're historically extremely strong. Debt is relatively low across all sectors and so forth. It's just kind of hard for a scare, a problem, even a genuine problem like rising interest rates and costs of housing. It's hard for that kind of problem to translate into a recession with legs on it when the base is financial strength, when there isn't some added problem like a lot of reckless debt, which suddenly looks vulnerable. So the answer is housing market hasn't been killed by this, and I don't think it's going to be killed, but it is going to need time to adjust and adapt to a 40 to 50% rise in the costs of buying a home. Will it be able to adapt? I kind of think so. Will it take some while to adapt? My common sense says, yeah, 3 more months, 6 more months, maybe well into next year. Will it take 2 years to adapt? I don't think so. No, we've lived through plenty of periods of time where 5, 6, or even 7% mortgage rates were tolerable to Main Street USA, and those periods of time in the distant past were periods where household financial strength wasn't as strong as it is now. So I think the red hot housing industry days are behind us, but I do not think at all that we're looking therefore at a collapse of the housing market. I think we're looking at a pause and then a steady resumption of growth. It won't be as fast, but it'll be enough to make money on for people who are in the housing business and in the home remodeling business and so forth.
Dave, who do you think the winners will be in the next 6 to 12 months?
It's I've worked in the investment world for 45 years, and I've seen that nobody's good enough to answer that question and stay right about it. Eminent people get lucky and they get famous, and then when they get unlucky, the media doesn't notice because they're on to something else. The great question is, that's my non-answer. The great question, of course, is who are the winners over the next 5 years or even 10 years? Because it takes that long for the hard work and ingenuity, which are what Main Street USA is all about, to accomplish their miracles. And they do accomplish miracles, but it never happens in 6 to 12 months. So anyway, that was my non-answer. So here's my fun answer, because you always have to have fun in our business. Industrial commodities like copper, oil and gas, and even steel are going to be winners for a long time. They won't be winners in an uninterrupted rocket ride upward, because nothing ever works. Things don't work like that. Markets ebb and flow. Markets are a roller coaster always, but that roller coaster can be generally pointing up, or it can be generally pointing down. And for heavy industrial firms and other firms very directly related to commodities like copper, oil and gas, and some of the industrial minerals, I think their long-term future is just a very solid upward path. And we suspect that the next 6 to 12 months is going to see a continuation of the upward path they began about 6 to 12 months ago. In the long run, the world simply needs more of copper, oil and gas, and key industrial commodities. And there's just no way around the world needing more of that. And for the last almost a decade, a great part of the industrial world has been pretty shy about spending much money on increasing supply of those things. In the end, everything is all about supply and demand in the end. And when you can look at sectors like copper, oil and gas, and heavy industry and so forth, and you can say demand is going to be there, but supply has been choked off since about 2015. It's a good looking picture.
Thank you so much for being here today. We appreciate all your insights and wisdom into what's going on and what we can expect to see over the short and long term. Nice talking to you as always.
It's a pleasure as always.